Okay, Chapter 6 is about bonds, specifically the characteristics and valuation of bonds. The, we'll talk about basic characteristics of debt, some different types of debt, short-term, long-term. Talk about bond ratings, the information that they provide to investors, their importance. We're going to talk about how bond prices are determined. Your homework is pretty extensive. The calculations with regard to bond prices, bond yields, yield to call, so forth. We'll talk about how bond yields or market rates are determined. One of the things I want to make sure the textbook uses a lot of different names with regard to bond yields and so forth. The required rate of return, going rate of interest. Just so you know, if you're talking to a professional, anybody who deals with bonds, they're going to be referring to the yield. Yield is the interest rate that is used to calculate the price. They're not going to say going rate of interest or required rate of return or anything of that sort. So this in the all exam questions will be written in that same manner. Just so. We're going to talk about the relationship between bond prices and interest rates and explain why it is important for investors to understand this relationship. It's an inverse relationship, as we mentioned when we're talking at the end of chapter 5. Bond interest rates go up, bond prices go down. Interest rates go down, bond prices go up. Characteristics of debt. Principal, base value, maturity value, par value all refer to the same thing. That is the amount of money that you're going to receive when the bond matures. Most of the problems in the book, or almost all of them, talk about a maturity value of $1,000. That's common for practice, but for the most part, bonds typically involve very, very large purchases in the millions of dollars. Interest payments are also coupon payments. Most people would refer to it as coupon payments because it's the coupon rate that determines the coupon rate multiplied by that face value. Maturity date, that is the date that the bond stops paying interest and the date that principal is returned. Priority to assets and earnings, the bonds or debt typically falls in front of equities, the stocks, and preferred stocks. And then finally, control of the firm. Bonds rarely ever have, I'm not aware of any that have voting rights. There are convertible that can be converted into common stock, but those do not have voting rights until you convert them into the common stock. Types of debt, short term. The mentioned in the last chapter, Treasury bills. Treasury bills are available. See there. 14-day, 28-day, then 91-day, 182-day, and 364-day. That's had the right amount. So there's 5 different maturities of Treasury bills. Treasury bills are the most secure instruments in the world. They are the most liquid. They're most heavily traded. That's, as we mentioned before, that's why the interest rates fall so low when we have difficult economic times. Repurchase agreement is the sale of a financial asset. See my typo there. Asset to another firm with a promise to repurchase those securities later at a higher price. Treasury notes, particularly the 2-year and the 10-year, are the most popular for repurchase agreements. Federal funds are overnight loans from one bank to another. The Fed funds rate is set by the Federal Reserve Bank. It is one of their tools for controlling monetary policy. If they want to slow down the economy, they will raise the rate. If they want to speed up the economy or increase economic activity, they will reduce the rate. The Fed funds rate, I don't know exactly what it is right now, but it is very, very low right now. Banker's acceptance, referred to as a post-dated check. Banker's acceptances are used in international trade to allow, basically, a bank steps in and acts as an intermediary between two companies doing business that may not know each other very well. So it creates two companies that don't know each other very well may not have a whole lot of trust. So this banker's acceptance assures that the transaction occurs. Commercial paper or promissory notes issued by large financially sound corporations. The commercial paper in recent years has become the preferred way to finance projects under development or construction. And what the company does will draw it down and increase the amount they have until the project is complete, and then they will take it out and finance it long term. Certificates of deposits are CDs. They are time deposits. They can be at a bank or other financial intermediary. When we're talking about CDs, in this case, we're talking about negotiable CDs. The very large denominations, $1 million or more, so forth. I'm not talking about the types of CDs that you go to the bank and invest in for some period of time. Euro dollar deposit. The deposit held outside the U.S. That is not converted to the currency of the foreign country. For example, many years, or in 2012, 13, somewhere thereabouts, Apple was heavily criticized for their euro dollar deposits. They had deposits in Ireland, large, they were US dollar deposits, so those would qualify as euro dollar deposits. Money market mutual funds are pooled funds that are invested in money market instruments managed by brokerage firms, investment companies, so forth. These are typically invested in U.S. Treasuries, commercial paper, very high grade securities. Long-term debt. Term loans, loans obtained from a financial institution in which the borrower agrees to make a series of payments consisting of principal and interest on a specific date, very much like your car loan. Term loans are less common in the U.S. because of the requirements that are placed on banks in the U.S. Bonds, long-term contract where borrower agrees to make payments during life of a loan and repay the principal amount borrowed at the end of the bond. We'll start the next lecture with common types of bonds.